Good morning, traders. Today is the 10th of May, 2021. My name is Neville Hornsey, market analyst with You Trading, and today I'm joined by...
My name is Joel Frank, also market analyst at You Trading.
How are you doing?
I'm all right, mate. How are you getting on?
Very good. It's a good start to the week. Market seems to be moving.
It is.
And it's a full week because last week was a short week, hence why we weren't here.
Yeah.
But,
I know, how sad. We have to be in for a whole week, mate. It's just awful.
Yeah, but it's all right. A couple more weeks and there'll be another bank holiday. It'd be great.
True.
So yeah, quite a lot happened obviously at the end of last week. What do you want to start with?
I mean, yeah, like we were just saying when we were talking a second ago, NFP is the big thing really that's happened in the markets last week. Like, obviously, markets were expecting this big number, 1 million jobs added to the US economy. What they actually got, I think it was 266,000 jobs, which was massive disappointment. And it was kind of, one of the big surprises was the difficulties. There's a lack of demand for labor. Yeah. It was the difficulties that these companies were having actually finding people. And there's all this debate going on. I mean, I don't know. What do you think about this? Because there's sort of two arguments. One of them is that the benefits at the moment in the US are too generous, and they're disincentivizing some people to go back to work because they're making more money than they would in their minimum wage jobs. So I don't know. I don't really know what to think. Is that a major thing in your opinion?
I think just that statement you just said. So if you were to receive a relatively low amount of money from the government for a month to live on, and that was more or equal to what you were currently earning in your job, that just shows how poor the wage inflation has been in the last however many years, and how why would you want to be just kept busy to earn a pitiful amount of money when the government's willing to step in? The government's the one that said, right, everyone's got to shut down. It's up to the government now to obviously entice people back to work, but it's up to the whole industry, the whole economic sort of complex to decide whether or not they want to pay more for people to actually work, because they've been crushing wages for so long, so much so that people can actually live on relatively low amounts of money. And I think that's the saddest part, that wage inflation hasn't.
It is sad, yeah.
And it
is sad. It's been awful.
And the amount of money that's gone into the economy recently, obviously, before the stimulus, there was tax cuts for like the rich, and that's kind of a theme that's been going on. So maybe it's time for the poorest or the lower middle class people to actually get some help, and then hopefully a change in the narrative where they can get more wages in the future. Maybe this is needs to be dealt with now. So that's the only sort of thing I think could be positive, is because 266,000 jobs of a month, that was good pre-pandemic. And and if there's 9 million people still waiting for a job,
that's the thing.
Someone needs to do something. Yeah, so someone needs to do something.
Like you say, when the unemployment rate is 3.5%, like it was before the pandemic, 266,000 jobs is massive. Yeah. But when the unemployment rate is, and also the participation rate is a lot lower, and the unemployment rate is a lot higher, so the slack in the US economy is massive. So it's like, I think what they want to be seeing is like 1 million getting added each month, like million jobs, and then you can slowly grind back. But if they can only add jobs at 266,000 a month, it's going to take them like 10 years to get back to the
it took from 2008 to 2019. That's a good chunk of time, isn't it? And the economy still wasn't like brilliant. Like the inflation, it was almost full employment. Inflation wasn't necessarily rising because there was still quantitative easing, sort of signaling that the market wasn't perfect. So it could take 20 years at this rate. If they're going to carry on the same system.
I don't know. I think this one's going to be quicker. I mean, I could be wrong, but last time there was like a lack of demand for labor that was holding back the improvement in the labour market. Whereas this time you've got the demand from businesses. Businesses want to hire. So hopefully, things will get better. I mean, it's not just about the benefits being too generous. Like I saw there was a lot of stuff being made about the fact that there's still a lot of fear of the virus. So as vaccination rates go higher, then I guess, and people become less fearful, that will also entice a lot of people back to work. So I don't know. I think, by the end of the year, once the unemployment benefits are mostly gone, once everyone's vaccinated, I think the US economy should be, or the labour market should be improving quite rapidly.
Yeah.
And like you're saying, hopefully the labour market can tighten quickly. And then once it's nice and tight, 3.5% unemployment or whatever, then that can start putting some upwards pressure on those wages for the people at the bottom.
Yeah, and Fed Chair Powell said, some of those jobs are just not coming back. Some of those people there's probably more people unemployed than that statistic, from NFP just said, because, it's after a certain amount of time, they're not counted as, in the employment sort of sphere. And a lot of that might even be just people retiring early or at an age where they feel that they can now retire because they've obviously seen a lot of people die around them as well. And, last year, people's minds changed about a lot of things, didn't they? So if I was nearing retirement and I had the opportunity to, then maybe that's what's happened as well. So
yeah, I think you're right. And that is a shame. And that is the lasting blow to the US economy as well, isn't it? If people retire early, because that's like a permanent, push lower for the participation rate. But
people that could work choosing not to, there's all sorts of different reasons, isn't there? So, but the market reaction was,
that's what I was going to say.
Intense.
The market reaction was so good.
Well, unless you're holding $1 long.
True. By good, I just mean it was big.
Yeah, it was big,
and exciting.
Yeah. It was. It definitely made up for the craziness of the actual numbers. So, should we look at a chart?
Get a Dixie chart up. That was good. And we can look at any charts really.
Yeah.
We'll go through all of them, all the major ones. All right. Start with Dixie.
So the dollar, I'd had a couple of rising trend lines, just because I did the closes, that's the dashed line. Then I did the sort of extremes, and I felt, it'd be great to get rid of the sort of liquidity below this swing low here. So we've obviously taken out that, but more importantly, I think Friday's price action was obviously extremely large, and it closed at the lows. So that signals that, whether or not you look in trend lines or not, it's a changing sentiment. The momentum hasn't changed. Obviously, the moving averages are pointing downwards. The 50 is below the 200. It's in a major dollar bearish move. So these swing lows here, I just think, are the most obvious targets. And if we can get below $90 and hold, for a couple of days, then I think this is going to test the lows. So it's I think you're right. It's like often when you get these types of moves that are catalyzed by like a big fundamental event or big fundamental shift, they can last for at least a week sometimes, can't they? And I think the main thing that people were talking about with this NFP data is the fact that it, at the very least, it relieves pressure on the Fed to be hawkish in terms of like moving towards QE tapering, or even they're going to have to be more dovish with regards to their language on the economy now to reflect that downbeat data. So it's just all about dovish Fed really. And I saw a lot of people saying that because a lot of people, there's that Jackson Hole event in August. Yep.
A lot of people thought the Fed were going to signal QE tapering in August, but now I saw some people saying I don't think they're going to do that anymore. I think they'll wait until the end of the year. So
I think with because last week we had Janet Yellen, the US Treasury Secretary, having to backtrack on comments made about overheating economies and rising interest rates. I think Jerome Powell is going to basically say at the next FOMC, "I told you so." So that's what he's going to say. Like, just this is transitory inflation. There's been a supply shock. Whether or not he's right, I don't know. But I think he's going to say, "I told you so," like at the next meeting, because I think this next month is going to be everyone expecting a lot more stimulus down the pipeline.
Yeah, I think this weak data, it certainly sort of supports the Feds, because the Fed are in this kind of stance where they don't want to set policy based on their forecasts. They want to set policy. They want evidence. Yeah. So this recent bad data obviously sort of supports that stance, doesn't it? Because their forecasts have been so bullish, and the more hawkish people have been saying, not necessarily hawkish policymakers, but there's hawkish people in the market on Twitter and stuff been saying, oh, they're expecting 6.4% growth, they should be tightening now. And it's like the Fed is saying, hang on a minute, let's just wait and see what actually happens. And then you get this weak data. Now it's like, well, thank God they haven't already started QE tapering, you know what I mean? Because that would have been,
they'd have to
given the
backtrack.
latest data.
Yeah, they'd be like,
exactly.
They'd be seen to be just following the market, like up and down, wouldn't they? Like traders chase the market. You don't want to see the Fed chasing the market. That'd be awful.
Yeah, yeah.
Like,
oh God. But, So it definitely supports their sort of patient stance.
Yeah.
Which is obviously negative for the dollar. But I don't know if you want to pull up the S&P 500.
Yeah.
Or maybe
I don't
gold
really,
or
because I the last time I spoke to you, it was a couple of weeks ago, obviously, and we were saying, you can't have like 5 to 6 weeks of up. And now this is the weekly chart. We've got 1, 2, 3.
How wrong we were.
7, with the last week being extremely outside bullish. Just like it's crazy. So
I mean,
we've been proven wrong. It wasn't a pullback, it was a sideways consolidation.
Yeah. I mean, I wasn't, to be honest, I don't really want to ever predict a pullback, because you just can't. All I was sort of trying to say is, if there is a pullback, I'm going to be buying that dip. Like,
yeah, but you would have thought, like,
if there's a pullback.
Yeah, like just going on just general moves, just the amount of green, like from top to bottom, whether it be 3 weeks or 4 weeks, it's a similar sort of range of movement each time. It's like a measured move.
Yeah. And
this one's definitely like pushing the extremes now. This run of green is it's large. It's probably going to be like 1,000 points by the end of it. So, well, now I've said that, that's the top of the market, but just like, but if this is going to be a big outside bullish green move, it doesn't look like a blow off top. It came down, it tested the previous couple of weeks of support, and now it closed at its highs. So,
well, it's had fundamental reason to go higher, because I think everybody kind of agrees that there's not really much room for further equity upside from valuations, because valuations are already really stretched.
But earnings was really good for the majority of the S&P companies. Yeah. So they are benefiting from all this money into the system.
Yeah, but I think the earnings being good kind of makes people not worry too much about valuations being really high. Like, imagine if earnings were rubbish, then obviously people would be like, oh my God, earnings are bad and valuations are sky high. But I think like when earnings are really good, that means that people are comfortable with the valuations. But then obviously when the market's expectations with regards to like Fed policy become more dovish, that's a positive for equities typically, isn't it?
Yeah.
So,
and I think we just quick look at gold, obviously on the back of weaker dollar. I don't think this is an inflation sort of move. I think this is just weaker dollar at the moment. So, with the yields sort of stopping at March, March seems to be the peak in the PMIs, the highs in the yields at the moment on the US 10-year. So I think this move in gold is it's not signaling anything other than, I believe, a weaker dollar. That's what I see at the moment. If you take into effect all the other stuff.
Yeah. What do you think about, we've got that trend line coming up. When we test that, I got a feeling that we could break that and then potentially test that high. When is that high? Is that the January high or something, or December?
So this one here.
That one's the August one, isn't it?
Yeah. So this one's 6th of January. So yeah. So this year, beginning of this year, and then it sort of collapsed But yeah, I think as a trend line, it's not really valid until the third touch. So even if I went to the closes, we're still not there yet. So
No.
with the extremes of the wicks, if it gets to the trend line and it holds and reverses like it did, with these big outside sort of day bearish candles, then you can say, okay, that's a legit trend line. But at the moment, if anything, this one up here is probably more legit. So
yeah. I know what you mean, but I just got a feeling with that trend line. Obviously, we've only got two points of contact at the moment, but I just think a lot of people might be watching that one because it's like the.
Yeah, I think they're definitely going to target.
So it might be,
they're going to target it, and then it'd be interesting to see when we're there. Yeah, if somebody was long, I would definitely stay long until we touch it, and then just be prepared for something like this to happen where you get a big outside day reversal. But until we get there, I mean, the 50 is starting to sort of curl up. It obviously hasn't crossed over the 200, but I imagine if we go to the weekly, it's just it was a bearish correction within a big bullish move. So if that breaks higher, then again we could say that's a flag. And this is the pole, and we go out to that crazy number again. But yeah,
I'm gonna make a prediction.
Go on,
and we can remember this and come back to it. But my prediction that I'm gonna make now is that if there is a breakout from this little consolidation, it's going to be to the upside. I don't know if we're going to go back to all-time highs, but it's going to be to the upside. And I think it's going to be because I think real yields obviously very important for gold. I think real yields are going to stay low, but I think inflation expectations are going to rise.
Okay.
And that I think is going to be bullish for gold, because think about it, like this week we've got CPI in the US, and it could be like 4% year on year.
Yeah. But when do you feel obviously the pandemic low data? When do you when inflation was zero, economy was zero? When does that actually roll out? Do you think? When is it? When the stimulus sort of got into the system? So say, well, that'd be like now, end of May.
It's hard to say. But, I think it's like May, yeah. Yes. I'd say probably May. But I basically, what I think is going to happen is inflation is going to be higher than markets expect and more persistent than markets expect. But the Fed is going to just stay dovish. They're just going to stay dovish. So when you've got higher than expected inflation, but the Fed refusing to budge from its really, really ultra dovish stance, that's going to be a recipe for higher inflation expectations. You might see higher nominal bond yields, but not higher inflation-adjusted bond yields. And I think potentially gold could go higher on that.
Yeah.
So yeah, that's my call. But let's see.
Yeah.
I mean, I don't know.
We'll say
next couple of weeks.
The measured move, if we do get a breakout, would be say to 2,250. Just call it a round number. So yeah, I don't think it's going to go 2,500, but 2,250 would be an amazing, everyone's like hoping for $2,000. If you're thinking of being like a gold miner or, anyone involved in the sort of production of gold, then $2,000 is a really high valuation for gold for them. So the market may be able to push through that, try and increase some miners to up their production, and then gold would come down a bit. But we'll see. That was a good one. So copper, that is just absolutely. Did you see? I think it's the CEO of Glencore said it needs to rise up another 50% from here. So on this,
really,
to get enough producers to step in, because the mining industry is being so underdeveloped. Because it's just cost a lot of money to set up a mine and get it going. But if it was to go another 50% higher than this, I mean. Yeah,
that's ridiculous, isn't it? 50% higher. Yeah, I mean, it's the surge in. There's all this demand because you need copper. Copper's a really good conductor, isn't it? And they want it in all the renewable electrical machinery, like the cars and all that other stuff. So
to get the 2030 to 2050 zero, emissions, then copper's. I think copper is the critical metal. So maybe. if there has been a lack of sort of mine development, production, sort of infrastructure and all that, then these higher prices will start to pique their interest, and the demand is obviously really there, so that's good. Obviously Aussie dollar is commodity that's doing well on commodities and on weaker dollar, so that's good.
Iron ore and stuff, that's doing well, so that's helping Aussie. Copper obviously helps Aussie.
Crude, it seems to go sideways, go up, go sideways, so currently coming out of a consolidation.
I mean, it's got a positive bias that's pretty decent, but it's not, I think it's like, for example, the India situation's still getting worse. Like, they're probably going to head into a national lockdown in the next couple of weeks. So until those concerns are cleared, I think the gains are going to be measured. But then once the situation there improves, I think we could see an acceleration of the upside.
Cool. I guess we should look at some currencies nearer to home. So you've got the British pound versus US dollar. That's thankfully broken out of the 300 pip range between 1.4 and 1.37. So if I just mark that up. So that
was a good range, that, wasn't it?
Yeah. So that's, we did. My fear was that we would come down and sort of test this double bottom sort of low, because there'll be stops there and liquidity, and push down to the 200 rising EMA. It would, it's kind of a decent trade if you were to get it to happen. But with the weaker dollar, we've broken out, so it's good, higher.
And outlook, UK economy is going guns blazing at the moment, and we're about to ease again on the 17th, ease restrictions even more. So
and politically, the country seems quite stable. The Conservatives are, obviously still in power, and more so than, the sentiment's good for the vaccine. So the Conservatives have done quite well off the back of that.
And the Scottish National Party, they didn't quite get a majority, but they do have a pro-independence majority when combined with the Greens. But they're not even going to push for a referendum on independence for Scotland yet, because I think that they're clever and they know that it would be seen as like an insensitive time to do it because of the pandemic. So that's something we can put on the back burner as well.
So I think pound good. So that's euro. I got a big outside weekly candle for the euro, again on the back of weaker dollar. But how do you feel about Europe? Because there's obviously wasn't so long ago they were going into like further lockdowns, but the German production seems to be, they're exporting and doing all the things that they normally do. Things are going quite well there.
I mean, I'm not massively bullish on euro, but like obviously if the dollar is going to keep going lower, then I think euro dollar should keep going higher. And like you just said, Europe seems to be doing better than we feared a couple of weeks ago. Like, they're coming out of lockdown. Economic data is okay and likely going to get better. Their vaccination drive is actually going really well now. Like, it's still a bit behind the UK and the US, but it's accelerated a lot, and they're going to hit I think they had a target of 70% of adults by July, and they're going to hit that target, it looks like. So it's not going bad.
Not going bad. Is there anything else that you want to take a quick look at?
No, we've done everything.
Well, we didn't do dollar yen. I'll just have a quick look at that because I haven't looked at that for a while.
Oh, okay, dollar yen's an interesting one, definitely.
So on a daily chart, just doing it on the fly, obviously. It's such a weird pattern, isn't it? Like when you get that big bullish move up, and then obviously Japan, I keep reading that the sentiment around the Olympics isn't overly bullish. They don't want like 10,000 foreigners turning up and potentially causing more disruptions.
59% of Japanese people want it cancelled or something. That was the weekend headline. And I mean, truthfully though, I don't think that's the main thing for dollar yen right now. I think the main thing is risk appetite and also like yield differentials. So what happens with like US bond yields? So Yeah, I mean, like dollar's been weakening recently, but the yen has kind of struggled to take advantage of that because risk appetite's also been good.
Yeah.
So yeah, as long as if stocks stay supported, I think the yen is going to struggle.
So the only time I do this is like when there's like a compression of prices, and then like an expansion of that range, and then it looks like there's been a move, obviously, to like the 50% of that previous. There's my Fibonacci. Just have a quick look.
Oh yeah.
Yeah. So yeah, I think after a compression and then an expansion, there's generally a trend. You know, it's like when price breaks out of this expansion zone. So yeah, that's one to look at. Maybe the highs like 110 or the lows of 107. Whichever way it breaks, I think is the trending move. But
until then, I guess consolidation.
Yeah, it would be. Yeah, like I say, the outlook economically and macro is kind of mixed, isn't it, for both the dollar and the yen? So I guess we're waiting for some sort of BOJ statement, which sounds really positive or really dovish, you know, just to get it moving. Or maybe some sort of risk appetite to come in to everyone to move to the yen. So, but yeah, I wouldn't trade it just yet. All right, that seems to be it.
Yeah.
I hope you have a great week, and it was good to catch up.
You as well, mate. Good to catch up.
Yeah, and I'll definitely see you next week.
Yeah, speak next week, mate. Have a good one.
Bye.